So let's start talking about the trend is your friend. Now, in tonight's class, I'm going to use the term security when referring to tradable financial instruments, anyone's. But I might say the euro, I might say Bitcoin, I might say Facebook, but I'm just using those as generalities. I'm talking about all publicly traded financial instruments in which an open market exists. I'm also going to intermix the terms investing and trading. Now, since we're all here part of ETX, we're traders, and we know the difference between a short-term trade and long-term investing, but I intermix the terms because, again, it gets boring, very boring just saying trading, trading, trading. Now, once we've learned how to read a Forex chart, which isn't that complicated, but takes some expertise, takes some practice, and we've decided what style of chart and what time frame we're going to look at, we have to be able to make some sense out of price. Now, don't forget, we can look at a line chart, a bar chart, or a candlestick chart. Because what we're looking for is the open, the high, the low, and the close. But what we're ultimately looking for is a way to identify a trend. Okay. Now, trends don't particularly have rules about them. We have trend lines that are a rule-based tool, but a trend itself is basically where the market is flowing. You have trends in fashion, you have trends in colors of automobiles, you have trends in types of automobiles. Okay, anytime that a business can see a trend and validate that trend, they can make future business decisions. Now, price, the price of an asset in our market, we only have three choices. Prices can be trending up, they can be trending down, or they can be moving sideways or in congestion. Now, most of the time, the market's moving congestion or sideways movement or not in defined trends. Now, I'm a firm believer that price action is the only governing factor about the markets, and that price itself is completely and totally random. Because price is all made up of the consensus of human beings buying and selling assets, at what price they're willing to buy or sell, and their demand. And since it's all made up of human beings, it's random. But within this randomness, there are certain times that price is non-random. And those times we usually are defined as trends. We have an uptrend and a downtrend. When we have an established trend, we're seeing non-randomness in the market, and then we can apply rules and make sense of what price might be doing or where it might be going. The rest of the time, we just have stuff all over the place. Now, remember, we have short-term trends, long-term trends, and intermediary term trends. And you can have a short-term downtrend within a long-term uptrend. And we want to define these trends and what they're used for. Because trends, okay, again, I'm not talking about a trend line. I'm talking about the overall movement of the market. Okay. A trend can help us decide where price is going. And when price starts either trending up or trending down, it takes a lot of energy out of buyers or sellers. And once the buyers are committed, you'll find that price will continue running in that direction. But again, once we've identified these trends, we want to also then start making sense of them. So we can have price moving up in a well-defined trend, and a well-defined trend should be push, ease, push, ease, push, ease, where price is making higher highs and higher lows. That means each time it pushes up, it reaches a new high. And then when it eases back down, the low that it makes before it turns to move back up is higher than that previous low. And when you have higher highs and higher lows, you have what's becoming a well-defined trend. Because see, price can be here and end up here, but it could have moved like this, where there's nothing definable. You don't have a trend. You don't have higher highs and higher lows. You just have price spurts. So once we can see these waves or patterns or cycles taking place, we can start seeing how well they are defined. Because what we're looking for ultimately to begin your trading is a well-defined trend. The more well-formed the trend is, the better trade possibility you're going to get. So when you see price jumping all over the place and making no sense, you might as well just walk away from it. There's no sense in standing there trying to waste your time trying to find a trade. Because if we only want high probability trades, okay, because the market offers a zillion trades all the time. Now, for instance, when it pops up, we're looking at my teaching chart. This is the Euro US dollar. I usually start this out in a 30-minute chart. Okay. On the 30-minute chart, you can see, and I've already drawn a trend line on here, but you can see price pushing up, easing back down, pushing up, easing back down, pushing up, easing back down, pushing up, and easing back down. It's not pretty, but this is definitely an uptrend. But when we look at price in short-term time frames, we don't necessarily get a picture of the asset. What we're getting is a short-term movement. When we move back to a longer period, okay, we actually see a nice upward movement, but we also see that price is coming off of a very strong downtrend. And this might, over a long time, just be a push and an ease, a push and an ease of a much longer term downtrend. So if we were to push this back to a 1 day, let's go for a 4-hour chart. Okay, what we see is that price overall is moving in an uptrend. Here's our short-term green line, here's our long-term trend. And so what we have is a short-term, beautifully defined uptrend, because when we look at it, look how beautiful, push, ease, right on the trend line, absolutely beautiful. The longer term trend again is push, ease, push, ease, push, ease. And if you notice, each time we're making a higher high, and each low is a higher low until we get to this point. And what we should have gotten was the push and the ease to a higher high. But when we can't make that higher high, we know that long-term trend is most likely coming to an end or having some type of a problem. Now, that's not saying this won't push back up, and this just became a bigger ease in that trend. Okay. As long as it stays above this trend line, it could continue in a longer term trend. But what we do is we look at these longer term trends for environmental to give us an overall feeling, because I would need to know that the overall pressure is bullish, that the price is being pushed up. Okay, I don't want to get into a short sell in the middle of a bullish run. Now, for a very short-term trade, we might consider it, but I want to look at my longer-term time frame and get my established trend so I understand the overall characteristic of the asset. Then we could drop it down to a shorter term time frame. And for me is a 4 hour to maybe a 1 day to just get the characteristic of what the overall trend is. I use a 1 hour chart to determine if I would be taking a longer or short position and would I see a potential for a trade. I then go down to my 30-minute chart to use it to find entry points. Okay. So I'm using 3 different time segments and 3 different trends to figure this out. And if you notice, my green line is a shorter term trend. My blue line comes all the way back from that longer term trend. So this is telling me something about the overall demeanor of price. Because right now when I'm looking on the short term chart at 1 hour, I'm actually seeing a down movement, not an up movement at all. But right now we haven't put really trend lines. We haven't come to the rule-based trend. We are just feeling out the asset. We're getting to see what its characteristic is in this market. Now, when I drop to the shorter term time frame, we wouldn't even have seen that downtrend that we saw in the 1 hour. We see a beautiful push. It's not beautiful, but it's as nice as we're going to get. Push, ease, push, ease, push, ease in a trend. Now, where would I look to enter? I would have definitely, if I was sitting back getting ready to make a trade and I got the bounce off the trend line, I would have been looking to enter somewhere around here because this gave me a confirmation that the trend is holding and it should continue in its upward fashion. But this is just trends. This is like red cars are outselling blue cars. Well, maybe red cars outsold blue cars only in the last 6 months, but overall, if we look at it over the year, red cars have done worse than blue cars. And we go back and look at over the last 3 years, we find out blue cars hardly sell at all. So we have to understand so that we can understand what we're saying. Okay. We're saying that blue cars over the last couple months did really well. Who knows why? Okay. Statistically, maybe the dealers all had way too many blue cars, so they were giving bigger discounts on blue cars. I don't know. But over the year, red cars outsold blue cars 2-1. And then over the last 3 years, red cars have outsold blue cars 6-1. So I know I don't really I have a very short-term trend in blue cars, but would I then want to bet on blue cars? No, because there's got to be a reason, and that's probably what it is. The dealers were overstocked in blue cars. Now, once we see or analyze, let's go back to my PowerPoint. Once we see what the market's doing, we're understanding the personality or the characteristics of the current market and the current asset. Then we have to start putting some rules on here, because what we were just talking about is a whole bunch of subjective stuff that's left open to lots of interpretations. Okay, well, that's the personality. That's the new guy at work, and you're going to feel him out for a while, but you're not making any firm decision. You're going to wait to see how his figures are and how his sales are and how he interact. But you're making some generalities. Well, once you've got these generalities, we need to then start understanding them or putting them together to make sure they're not just a bunch of stuff in our heads that is actually really happening. Okay. So I mainly use trend lines to identify changes of the established trend. When you have a strong trend and suddenly the trend line breaks, it can signal a transition to a new trend. Trend lines during ranges are ideal when it comes to finding breakout scenarios when price enters the trending mode again. Also, trend lines can be combined with moving averages nicely because of complementary characteristics. So a trend line is a rule-based tool. Okay. It's not up to you and I. It's not something that we can customize. Basically, I should be drawing the same trend line you are, as the guy across the world in India is, as the guy in Australia is, as the guy in Alaska is. Okay. Because trend lines give us some start they give us some rules, and then we can use that to establish certain areas or certain levels that we can expect reactions. Because we need to have some basis of real stuff before we start personalizing, customizing to make our own trading decisions. But we have to understand somehow what price will be important to the market. What is the momentum of the movement? Okay. And trend lines are one of the tools that help us do this. Trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. Now, my basics for learning to trade is there are 3 basics that you have to do every day, every time. Look at your charts and understand and learn how to read a chart, not make trading decisions. Be able to look at a just price, whether it's a candlestick or a bar, and have it make sense to you, that you can talk to it and make sense. After that, you have to start putting pieces of information on your chart. No successful trader doesn't start out with trend lines and support and resistance lines. Now, our next class is in support and resistance, but everybody, you should, the old adage is the trend is your friend. You should never trade against the trend. And when there is an established trend, you shouldn't be trading at all. So there is a lot of mis and inaccurate information about trend lines. Learning how to use them effectively, if you're going to use them, is crucial so you don't fall into lots of common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets. Trend lines have the potential to alert us when a pullback is happening or over and a trend is resuming, or when a trend is accelerating or reversing. Now remember, price is the ultimate indicator, though. Therefore, price action must always be considered when using trend lines. Now, trend lines are drawn on your charts to help you predict the general direction of price. They also help us see reversals. Trend lines also help to determine good entry and exit points and help you decide where to put your stops. Wow, they should be called magic lines. Well, not so much so. They are quite good, but like any form of analysis, if used alone, they won't make you many pips. However, they make a great addition to your trading arsenal. Now, the main problem with trend lines is placing them on your chart. It can be a little intimidating to start with, but it's quite easy once you get the hang. And why it's intimidating is because they have firm rules. And too many traders, I say to a trader, a trend line can be drawn on a chart connecting 2 prices together. As long as you have 2 touches of a line, you can have a trend line. But that doesn't give you a valid trend line. And then traders always say, well, I can always draw 2 lines. And you look at their chart and they'll have 50 different lines on their chart, all being touched by 2 lines. Well, trend lines, like I said, are very defined rules. And a trend line, once it's violated, no longer exists. And there's no reason to keep it on your chart. So the purpose of drawing trend lines is to identify where possible reversals will take place. They can also signal that a change in trend may occur. In an uptrend, we draw the line along the lowest point in the trend without letting the lines cross through price. You need at least 2 touches to draw a trend line. Okay, so let's go over to my chart. In fact, I have a little presentation set up for you. I'll share that with you in a second. But let's go over to the chart. So in order to draw a trend line, we would look for the swing low. In other words, where price reversed and we want to find the swing low. We can then project a price forward. Now, if our chart had stopped here, we would have drawn this trend line to there. Okay. But if we had only looked at our chart up to here, our trend line would have come here. And then the minute it got broken here, that trend line would no longer be valid. So we would draw a new trend line because you're only dealing with a valid trend line. A valid trend line is a price line that hasn't been broken by price. Price has not gone through it. Okay. So hold on a sec. So if we had only seen price up to this point, and we had to draw a trend line, we would, or up to this point, because price hadn't gone any forward, it's the current price, we would have established our trend line here. So let's put one on the chart. Let's put a real trend line on the chart. And we would have taken it right along this price. Okay. Now, we take it from the swing low, we bring it forward, we need a second line touching it to be able to draw it, and then we want to draw it out into the future. But this two lines touching a price doesn't do much good for us. Okay, we can draw that because we've got to wait for the future. We want to look for a third touch of that line. So as price moves forward, look at that. We got a third touch of that price line, and we can keep extending it forward. Okay, and once we have a third touch of that line, that becomes a valid trend line that we can start using in our trading decisions. But then what happens here is we continue it forward. Price no longer agrees with us, and price breaks through that trend line. So this trend line is no longer valid. So we would have to now draw another trend line taking into account here. Now, let's say this is where we are. And then as price comes in and price breaks through that trend line, we would have to draw a new trend line, and you get to the green trend line that I recently put on the charts. Okay. And there's no need to keep these old trend lines. If you're using a strategy that combines multiple trend lines, you might want to keep it on your chart. But there's no need to keep a trend line that's no longer useful on your charts. So in this case, we had swing low, touch, and it looks like right now we got the third touch. So we have a valid trend line. But the minute this price breaks through it, now here we have some lows, some random that touched it but went right back in. Okay, we can say that as long as the close was above the trend line, it isn't validated. I don't like to use that. I find it more an excuse. I find that if we get a long, what we call a wick on a candle, these long wicks, and it touches and goes right through the trend line, but withdraws right back into it, that's just some random movement of some spark in the market. It's not really a trader's decision. The price fell down and bounced right back up. But now that we have a correct trend line drawn on this chart, we would have been expecting, okay, at this point, when price came down to this level, we would have been expecting some type of reaction. Doesn't mean price can't break through it, but so were all the other traders who drew the same trend line, waiting for reaction. We know exactly what price is the crucial price because it's right on this trend line. So we would have expected, as it came down, that the euro at 111.30 would have had some reaction. If it bounces off, we're going to expect, like it did, we're going to expect it to resume and continue its trend moving upward. And this was just the ease in the push and ease scenario. It could break through and just turn negative, and this could be a signal of a reversal. But what happens is everybody is looking at that price point. Okay, nobody knows what's going to happen, but everybody knows that that price will be crucial to the markets. So let me share with this little presentation, and I'll show you how to draw them on multiple times.
That we're going to be going over what makes a trend line. identifying a trend. This is really important, even if you're not using technical analysis. If you're a fundamental investor, you need to know if the overall trend of the stock that you're looking at is going up or down, as that's greatly going to depend on whether or not you make profit. There's two schools of thought. Some people use the upper wicks of the candlesticks or the lower wicks, and some people use the real bodies. Personally, I use the real bodies, and neither is right or wrong. It's important that you remain consistent, and inconsistency obviously will give you some wrong signals. So we'll look at some examples of the two schools of thought as well as inconsistent trend lines. And then last and most important, what do trend lines tell us? How can we utilize this information to make more profitable trades and investments? They're going to tell us potential reversals, breakouts, and then all these patterns, flags, pennants, channels, triangles, they are all dependent on being able to draw accurate trend lines, and then being able to see clear patterns breaking out or forming are going to give us one step up on the herd, so to speak, which are not utilizing technical analysis and seeing all of this price action visually in front of us. So what makes a trend line? The prevailing direction of a trend is composed of either higher lows on an uptrend or lower highs on a downtrend. Seems like a pretty fundamental basic concept. We'll look at some examples of that. But in terms of the trend line, you obviously need at least 2 points to be able to draw a trend line. But that's not enough in terms of having a valid trend line. 3 touches is the bare minimum needed for it to be valid. Doesn't mean you can't draw a trend line with only 2 touches, but that just means you don't put too much weight into it being an accurate trend line until you get that 3rd touch. And the more touches you get, the more valid the trend line is, and the more confident you can be. If you have a trend line that has played out over the past 2 years and it's touched that trend line 15 times, you know that the odds are more likely than not that the next time it comes down to that trend line, it will likely hold it again, just like it has done many times in the past. So let's get into some examples. This is a very visually dependent topic, so we're going to go over all kinds of examples of everything we just talked about. So this is gold on the hourly time frame, and we're going to be looking at what constitutes a downtrend, and it's the lower lows. Lower highs and lower lows. So there doesn't always have to be lower lows, and we'll look at a couple examples. A descending triangle pattern has a horizontal base and then lower highs as the price gets tighter and tighter. So we'll look at those examples, but lower highs and lower lows is the basic fundamental of what a downtrend is. And just think of stairs. If you're going upstairs, higher lows, higher highs, and downstairs is the opposite, lower highs and lower lows. So drawing a trend line, this is me using real bodies. So I'm picking a point to start that trend line at, and picking your point really becomes with practice, because if I were to start this trend line up back here, it would not be a good trend line because I would only be able to hit 1 point. So let's do some examples here. If I were to draw the trend line from, let's say, the highest price that was hit here, I would use that real body of the candlestick and I would get that one trend line. And when I'm drawing trend lines with the real body of the candlestick, I'm ensuring that no candlestick is closing above my downtrend line. So you can see this candlestick is poking out above it, but the close of that red candlestick is all the way down here. I'm making sure that the green candlestick closed right at my resistance line and then the price rejected. So I wouldn't want to draw my trend line here just because it hits twice and then the price action is all the way down there. I want to be where the action is at. So I would choose this as my starting point, that top on that bounce attempt, and then I would make sure to hit as many points as I can on the way down. But again, I'm just getting tighter and tighter and making sure that no price closes above my downtrend line. So if I were to pull it in and hit this point right here and make my focus right there, then I'm seeing that this breakout occurs, and this would make it an invalid trend line because obviously the price is not responding to it. So I want to give a little bit more wiggle room, and again, make sure that no hourly candlesticks are closing above my downtrend line. I'm closing right on it, right below it, and then there's that rejection. So I've got 1, 2, 3, 4 touches, and then it ended up touching a 5th time down here, and actually a 6th time right there before that clear break above it, and that is telling us that the bulls are showing up. So every time we rejected, another lower low followed through with it. Now that we have broken this downtrend line, that could be a bullish entry signal because we are seeing that the price is no longer rejecting from that level. Now, personally, not only is the break of a trend line important, I use trend lines as sort of a heads up. It's not all out in the bag for the bulls once that level breaks, because I'm all about price action. Price action is king in my opinion. So I'll be looking at these lower highs that are set, and these are forming resistance. Every time we make a bounce attempt and reject, that's a new resistance level to be watching. So we made a bounce and we rejected from 1202. We made another bounce, rejected from 1191, and then another bounce, the last one here before the breakout, rejected at 1186. So now that the bulls have gotten in control, that alone, breaking that trend line, could be a buy signal for the more risky traders. If someone wanted to be a bit more cautious, they would wait for the lower high pattern to break as well. So again, this top was at 1191. So once the price breaks 1191, we break the lower high pattern. So not only is the trend line important, but so is the previous price action. And because that's where we're going to be looking for resistance now that we're on our way back up again. So we can even draw an uptrend line here. When I'm drawing an uptrend line, I'm hitting the bottom of any red candlestick. I'm making sure no hourly candlestick closes below my uptrend line. So even though this green candlestick is dipping well below that trend line, that's the open of the candlestick, that's the close of the candlestick. Every single close here is above my trend line support. So where do we find resistance? We look back at the downtrend. Every bounce attempt rejected and formed a new resistance level. So I'm seeing a resistance level up here at 1202, and we are currently at 1194. So that is one of the next levels that I would be looking at. There was another little bounce attempt right here that rejected from the downtrend line. That level is 1198, so that's going to come first. So that's a clear downtrend line. Let's look at Tesla on the daily time frame. Very strong uptrend. So again, making sure no candlestick is closing below. We have plenty of lower wicks dipping below, but as long as the price continues to close above that level, it acts as support. So here we are. Visually, I zoom out and say, where do I want to start my trend? I want to start the uptrend line. Once we have our clear lowest price, and we had a little higher low here. So we can see once that steep trend started, right down at the base is where I choose that first candlestick to go off of, and then we touch that level, or we touch this trend line 1, 2, 3, 4 more times than you can count here. Well, I would hope you can count that high, but let's call it a dozen plus times, so we know that's a very valid trend line, and it keeps hitting it and bouncing. We're consolidating now where we currently stand, and we have this trend line support to be watching, and we can utilize this information because if we lose this uptrend line, that's a potential signal to reverse and look in the opposite direction.
So as you can see, the trend is your friend. But like all friendships, it's a complicated one. Unless you understand the nature of the trend, your friendship is destined to fail. As any trader quickly realizes, there is a great deal more to trading successfully than merely identifying a securities trend and buying on pullbacks in an uptrend and shorting bounces on a downtrend. So let's start with the basics. An uptrend is a series of higher highs and higher lows. A downtrend consists of a series of lower lows and lower highs. Now, there's all kinds of things out there. There's waves and cycles and all of that kind of stuff. You can make it very complex. And there are all ways to interpret these things going on within inside of trends. But let's keep it very easy. You have an uptrend, sideways trend, downtrend. Uptrends are denoted by higher highs and then higher lows. Push, ease, push, ease. Sideways trends are congestion. Prices bouncing up and down with no actual direction, or making higher highs and then higher lows and higher highs and same lows, same highs, same lows. Downtrends are the exact opposite. They're making a lower high and then a lower low. So they're pushing and easing, but they're just the reverse. Now, there are two main obstacles that you will run into when attempting to apply this traditional wisdom. First, not all trends are regular. In other words, while one type of support level may hold well in an uptrend, another may not. So combining it with other pieces of information is very important. A moving average will help you, a simple moving average, a 20-period moving average, a 10-period, will help you reinforce the direction of the overall trend and make sure you're trading on the side of the trend. We also have to keep in mind that no trend lasts forever. At some point, an uptrend will become exhausted and will break through support instead of pulling back into it and bouncing. And this is what we're looking for. We're looking for a change. If we're in the market, we need something to tell us we got to get out because the trend is changing. Or if we're looking to enter the market, we want to wait till to be prepared when we have something that the trend has ended. So without a solid understanding of how trends exhaust themselves and the tools for recognizing different types of exhaustion and how they affect the correction of a trend, you can easily find yourself on the wrong side of a market move. So most traders who pick up a book on technical analysis run into the concept of trend formation and trend development, whereby the trend consists of a series of three waves of the upside that are often punctuated by two small corrective waves. Now, again, this is what I told you, waves and cycles. It's not that I don't believe in this stuff, because it's been tested and it is quite true. I just can't see it. So I stick with my push and ease, push and ease, push and ease. Lots of people firmly believe in waves, trend, and understand waves. It's just like I can't see in my charts. I've been teaching Japanese candlesticks for years, but I can't see all these patterns for all the different candlestick patterns on my charts either. But this is me, not somebody else. So trend lines are one of the most used and misused tools in a trader's toolbox. If you're going to use them, you have to have a consistent methodology that defines when you will draw them, where you will draw them, and what you will do when price touches them. Too many times I have seen traders draw random lines on charts with the argument that they may not use them, but it's good to have them there. I tend to disagree. If you don't have a specific set of rules, then you will draw a trend line, you draw the trend line you wish were there, okay, rather than the one that's actually there. And if you do not have consistent rules, then you will probably just draw random lines on charts, which cannot help your trading and probably will hurt it in the long run. So first of all, we should define what we expect out of a trend line. There are legitimate trend lines connecting lows of a move to highs of another move, drawn on the best fit effort through the center of price action, or drawn through any number of other chart points. I have not found most of these to be useful in my trading because I expect something very consistent from a trend line. The main reason I use trend lines is to delineate the conditions that define the current trend for that market. If the trend line correctly defines those conditions, then penetrations of those trend lines are very significant. Now remember, you will continually redraw your trend line. Doesn't mean you had a bad trend line. It means price is doing what price does, and you want to continually to redraw them and have accurate trend lines. Now, you can redraw them by having your newest one in a color different than the previous ones, or like I say, I just get them off my charts. Okay, I don't want my charts cluttered up with invalid or invalidated trend lines. So remember, all you need is identify two swing lows or two swing highs and draw a line between them. There you have it. But it's not valid until you get that confirmed third touch of that line. So remember, and then when you're in an uptrend, you would draw them underneath of price. And in a downtrend, just the opposite. You would draw them above price. So here we could have drawn the trend line, but then we need to wait for that third point and get that bounce. We had a validated trend line as we exposed, but you see, and as price broke through that trend line, it moved straight into a downtrend. So the trend line break, and it gave us the end of the bullish trend. Okay. And you always want to make sure you have validated, verified trend lines with no breaks. There is no exception to the break rule. Like I said, long wicks of candles, when they just touch and go through and bounce back in, can be ignored. But a break with a close below or a break on, or a short candlestick or a short little wick that's just gone through it should not be considered an exception. So we connect swing lows to swing lows or swing highs to swing highs. The more times that we've touched that trend line, the more valid and more important it is. Okay. And each time the price bounces off the same line, the more likely it is that others are watching it too and playing the same game you are. That's what you want. You want everybody playing the same game you are. Then you want to come in with your spectacular play. That's when you can have your special plays, your special strategies, and everything else. Because once you understand what the whole market's doing and everybody else is doing, then you can then use your own personal trading decision or trade making decisions. So trading only in the direction of trend will let you exploit potential trend line bounces as efficiently as possible. And while they won't always give us winning trades, the trades that are winners should give us more pips. Because remember, the old adage, trade with the trend. Ultimately, you'll find picking points opposite the trend, you'll have a higher risk and you'll make less pips. Statistically, if you trade with the trend, you will come out overall successfully. So whether you use trend lines or indicators, price action is what ultimately determines how much money we make. Learning about price action and how trends move is never a bad idea. Once we understand the basic concepts of how price moves, then trend lines become a more effective tool in helping us analyze price action. So in our next class, we're going to start learning how to put a second set of lines on here so that we can start making or applying some basic technical analysis. And remember, technical analysis can be renamed chart analysis. It's anything and everything we do on charts. So what we're trying to do is make this chart into a roadmap. The more important, the more lines we put on this chart, the more likely we're not going to get lost and we'll get to where we're trying to go. So remember, trend lines show three distinct but related pieces of information. They show us the direction of the current price movement, they show us the strength of the current price movement, and future support and resistance. The strength can be determined by the angle, how steep it's going, how deep it's going, how high it's going. Okay, and these pieces of information can be used independently of each other, or they can be used together as part of a larger trading system. So remember, it gives us direction of price movement, strength of price movement, and support and resistance. Then we can start using them to look for things like chart patterns and retracements and breakouts. But we have to first get the right trend on our charts. So on that note, I'm going to say goodnight. And next week, we will start learning about adding the concept of support and resistance, and then how to combine them with trend lines to start making some interpretation of where price might be going. So again, thank you very much for joining us. Thank you for being part of ETX, and have a great weekend.